Never get stopped out again. In my trading career, I was losing thousands of dollars because of stop loss traps until I discovered how smart money really operates. In this video, I will weaponize you to beat these top hunters. I prepared for you 4 efficient strategies for safe entries and stop loss placement to avoid the traps of smart money. Please don't forget to like this video, subscribe to my YouTube channel, and learn the tricks that banks don't want you to know. Rule number 1. Trade from liquidity zones. Smart money feeds on liquidity. That is why they hunt your stop loss. Every trap, every fake out is designed to grab your money before real move begins. And the market liquidity accumulates and distributes within the liquidity zones. High saturation of liquidity always lowers the chance of the occurrence of the market manipulation. When big money flows, the need to hunt stop losses disappears. That is why strictly search for trading opportunities within the zones and trade only from the zones. Check the price action on a dollar CAD pair. Here I spotted 2 significant supply zones and 2 significant demand zones. And you can see that the price of a dollar CAD pair is now trading beyond these liquidity zones. Learn smart money concepts with my SMC book. Look inside the book on my website. The link in the description below. And following the plan, I strictly wait for the test of one of these liquidity zones first, and only when one of the liquidity zones is reached, I look for a trading opportunity, and while the price is staying beyond, I wait. Rule number 2. Wait for a trap first. Of course, the market manipulations also take place within the liquidity zones. For that reason, instead of placing the trade and hoping that smart money will not hunt your stop loss, let them make their move first. Wait for a trap and only then open a trade. With that approach, you are not avoiding the manipulation, you are using that as the trigger. And here's what exactly you should do. You can see that dollar-yen pair is currently testing a significant supply zone. And of course, from that supply zone, we will expect a bearish movement. But before we place a short trade, we will strictly wait for the manipulation first. After a test of our supply zone, dollar-yen went up and we got a nice bullish trap here. And we strictly wait till smart money exhausts the manipulation, and only then we strike. When the market returned back within the supply zone, that was the perfect moment to open short position, and you can see how strongly the pair dropped then. Rule number 3. Use trap-based stop loss. Placing the trade, make sure that you set your stop loss beyond the highs or lows of the trap. If you sell from a supply zone, your stop loss should strictly lie above the highs of a bullish trap. And don't be greedy. Remember that there should be a sufficient distance between the high of the liquidity grab and your stop loss. Check that significant supply zone in a dollar Swiss pair. After the test of that supply zone, we got a nice bullish trap, and then the price returned back within that zone. That was the moment to sell the market, and you can see that a safe stop loss is lying strictly above the high of a bullish trap. And you can see that there is a very nice distance between the high of the trap and the stop loss. The manipulation may repeat one more time, and with such a stop loss, you are protected against one more bullish trap. Buying from a demand zone, set your stop loss below a bearish trap. That is how you should trade the demand zone. You can see that we got a strong demand zone on a Euro-pound pair. We got a test of that demand zone first, and we got a strong bearish trap way beyond the boundaries of that demand zone. After the trap, after the price returned within that zone, buy entry placed, and stop loss is lying below the lows of a bearish trap, and you can see that there's a nice distance between the low of the trap and the stop loss. Rule number 4, use multiple time frame analysis. Single time frame analysis is very risky and quite often is not sufficient for a safe stop loss placement. Once you identify the liquidity zone on one time frame, check the higher time frame as well. Quite often, higher time frame analysis will reveal the hidden parts of the supply and demand zones. That is a significant demand zone that I spotted on a Euro-Yen pair in a 4-hour time frame. Before placing any trade, before buying from that demand zone, we should check higher time frame. And the time frame that is higher than the 4-hour time frame is the daily. Analyzing daily time frame, we can see that the demand zone that we spotted on the 4-hour time frame is just a tiny part of a huge daily demand zone. And of course, once we spot such a huge demand zone, we will reason completely differently. Such a perspective and deeper analysis will help you to make more accurate trading decisions. The best strategy to apply these techniques is to learn to use them in a combination. That will give you a strong weapon against the traps and manipulations, and will help you to avoid most of the stop hunts. Integrate the steps in your trading plan, and good luck in trading smart money concepts. Let me know traders in the comment section if you have any questions. Also, learn how to trade smart money concept with my smart money book. For more info, check the link in the description below. Also, traders, please don't forget to watch my other videos. I have a complete playlist with a lot of useful SMC lessons for you.